Welcome to the 2023 Economic Preparation and Depression channel. Thank you for joining me on this Tuesday edition, Super Tuesday, September 19, 2023. Thank you for your support. We're going to be talking today briefly about the Federal Reserve meeting on Wednesday, what to expect according to CNBC analysts, and also we're going to talk about the pandemic money tracker. Where has the money been going to? And everybody's talking about how, we've had all the stimulus and different things, but how much did the actual ordinary Americans get from this? And the answer is very little. We're going to also talk about the employment situation. The unemployment rate has been rising, as you know, the last 2 months, and the official numbers are getting quite high. And it really has to do with the labor participation. As you know, we've had strikes at various unions, auto unions, various things of that nature. So that's also going to be a concern heading into the fall and winter months. The labor participation rate in various parts of America. So those things we're going to look at. And I ask that you continue. Thank you for your continued support. And let's get right into it here. Ladies and gentlemen, we have a Federal Reserve meeting here that is going to be, it's going to be basically as if they're expected to be continue to raise rates, according to Fed Chair Jerome Powell. So there's virtually no chance, quote, that the U.S. Central Bank will choose to raise its benchmark borrowing rate when the two-day meeting concludes on Wednesday, tomorrow afternoon. The meeting will feature Fed's quarterly update on what it expects for a bevy of key indicators: interest rates, gross domestic product, inflation, and unemployment, all of which has been rising besides GDP, which has been kind of flatlining the last couple of days. But that's worldwide. So from the European Central Bank to the American economy, to the Asian economy, to the South American economy, developing nations economy, the gross domestic product around the world has been flatlining, according to the economist.com, and that's what we generally should expect. So there's widespread belief that the Fed will make sure the market knows it shouldn't make assumptions about what is next. As you know, the markets love free money, cheap money. They love lowering the interest rates down. So they may let inflation run hot. They also will continue to raise rates, as I told you in previous videos, through 2024, past the election season. I believe, in my opinion, they're going to continue to raise rates because all of the indicators are indicating that the inflation is not cooling. Gas prices, according to AAA.com, is average around $3.90 a gallon and climbing for regular gas. That's the baseline average. In many places, it's higher than that, as you know, and it's continuing to rise. And food prices have been rising since, last year, March. So this has gotten out of hand. And while we're not to critical levels yet in terms of a complete meltdown, things are heading in the direction of a slowdown. I don't know if they want to call it, if the media wants to call it a recession or sort of a stagflation recession or a recession heading toward that, but there is a possibility of one more rate hike, according to Mr. Roger Ferguson. Fed funds rate is around 5.25 to 5.5%. Now, the good news for you and I is that we can continue to prepare also, and the good news is that we're getting time to prepare. And now with the student loan crisis, there is an extension given for those who want to defer payments for one more year. Payments are supposed to begin in October with the SAVE program. I guess President Biden's SAVE program, as he calls it, is supposed to lower the monthly payment for all balances on these student loans, federal student loans. So we'll see what happens with that. But in the meantime, we have this COVID response that's, they declared the emergency over in May. But as you look at the numbers here, look how much money has been spent so far, not accounting the war in Ukraine and other things that happened since 2020 or 2021. Legislative actions took up $6 trillion, of this COVID budget. Federal Reserve actions at $7.1 trillion. So that alone right there, that's $13 trillion just in policy actions, whether financial policy or legislative actions. And then administrative actions took up $1 trillion. That means paying for the people who's making all these legislation and reserve actions at the spur of the moment. So if you look at the money, if we follow the money here, most of us got a stimulus check anywhere in the range of between $500 and $1,400 combined, combining the two or three checks that we received during that time. Now, look how measly that is compared to the amount spent here. $13 trillion just in legislative and administrative actions right here. This is concerning because we've got this going on. The whole federal government and the whole state governments, local governments, they cannot stop spending money. and that's going to be crucial. That's going to be a critical issue of why this economy is going to continue to go down. So I just want to show you that to you. Have a blessed day. I will talk to you very soon in the next video, where we're going to be breaking down the jobs report and other things of that nature as well. Unemployment is up to 4%, guys, so it's rising slowly but surely. So let's keep that in mind too as well, as we look at the factors that's going to lead to a slowdown and a recession later on this year into the beginning of next year. Thank you for joining me. I'll talk to you very soon.